Here we go. Welcome to today's webinar, Investment Only Platforms, a showcase of the use and benefits. My name is Rachel Pine, and I look after content for the PLSA's events and training. Now, today is part 2 of this webinar series about investment only platforms, although it absolutely stands on its own. We're going to send around a link to the first part as well, which we filmed 2 weeks ago. We're delighted to have put these webinars on about investment only platforms with Phoenix. Today, they're going to talk about how the asset transition process works when moving to an investment-only platform, and they're going to present a case study on how that worked with one large scheme in particular. Speaking today on behalf of Phoenix are Jess Williams, Senior Manager of Corporate Investment Services and Relationships, and Nick Trinder, who is a Relationship Manager there. Jess is first going to take a look at how the transition works. And then joining us today as a special guest star, we have Stella Chaplin, who is Head of Pensions and Benefits at the Atkins Pension Plan. This is a scheme that transitioned to investment only, and Stella is going to participate in a mini case study to help describe the process. Before I turn this over to our speakers, I wanted to tell you a little bit about Phoenix. Phoenix are an investment-only platform with over £8 billion of assets under management, which they hold on behalf of large UK institutions. Phoenix have a 20-year heritage of partnering with pensions to meet their strategic and investment requirements for trustees as well as for scheme members. So before Jess starts, we're going to open up with just a really quick poll. And the first question is, are you planning on making any changes to your investment range within the next 18 months? So as you can see, so half of them are planning to make changes. Half of them say yes, 25% say no, and 25% are unsure. So Jess, that's a really good place to introduce you, I think.
Yeah, lovely. Thank you so much, Rachel. And I think that's really interesting that even in the current challenging environment, there's still 50% who are saying that there is the need to make change, and they see that coming, in the next 18 months. So thank you for that. Okay, good morning, everyone. Nick and I, with our guest Stella here, are really pleased to be here today. Thank you so much. But we're here to talk to you about managing transitions. And as Rachel said earlier, it's from an investment-only perspective. And I think I should just confirm what we're talking about when we talk about investment-only platforms such as the Phoenix one we're discussing today. We're referring to platforms that specialise in developing fund solutions for institutional clients, so for DC or DB schemes, or indeed master trust clients. Our relationship is with the trustees, working alongside the scheme administrator, who will hold the member records, and the investment consultant, who will advise the scheme. We facilitate access to the underlying funds and build a blend of those funds in white labels according to the client names, according to whatever the client requirements are. If you want more detail, as Rachel noted, about just the overall benefits of investment-only platforms, the first webinar from the 10th of September is available on the PLSA website for you to view. Okay, so today, managing change for these investment institutional clients as noted. Firstly, what are those challenges that are facing trustees and how they look to make change and provide the best outcome for their members? So I think firstly, it's understanding what the change is that is required. So what is the change you're making? Is this a change of investment strategy only? Are you just restructuring your underlying assets? Or are you changing other elements of your delivery, such as a change of the member administration or the payroll records, or changing your platform provider, where you actually access the funds from? Or maybe you're looking to introduce a decumulation product. How are you going to get from where you are now here to where you want to go? And how are you going to get access to those managers that you want for the funds that you need? And we're seeing this as being particularly true at the moment with ESG funds, because there are clients who are accessing fund managers who they haven't really used perhaps in the past. And so it's how you get access to those managers. It's getting the right expertise and resource to manage that project, that transition project, to support it and drive it through and engage all the parties, from the fund manager to the scheme administrator, coordinating legal agreements and agreeing what those timings are. It's ensuring you get that behind you. And then at the end of the process, it's being able to evaluate what was the process that was taken, what was the feedback, what lessons have been learned, and calculate what the implementation costs were and who's accountable for them. So I think we have a slide here to pull up, which is about what to consider when transitioning assets. So firstly, what is the type of transition you're making? Are you on or offboarding? Are you moving provider? And therefore you need to consider how you will move your assets efficiently with the associated legal changes and minimizing risk wherever possible. Or are you restructuring your current fund range? So assets are staying with your existing provider, but need to be overhauled. And this can be done over time, or do you need to do it at a given point, a big bang approach? The type of transition you're considering will affect the options that are available to you to enact this transition. And Nick will run through with you a bit later around the different methods that are available, depending on the transition you're doing. So firstly, what is your key objective? What is the best outcome? But what is the challenges to getting there and the risks that you need to consider? These will be bespoke to you and the change you are looking to make. But these priorities need to be considered upfront and reviewed throughout the project to ensure they remain on track. In particular, we find this is true around timings versus costs. When making change, we find that these are the two areas that clients are most concerned with and tend to pull them between about which is more important at any given time. Firstly, do you have a limited time to deliver this transition because of future strategy changes, or have a need for a restricted blackout period to lessen the effect on members? If so, there may have to be an acceptance that training costs may increase to get that transition done in the quickest time available. Or if you are happy to extend that trading blackout, this may help to bring overall costs down by giving you more options for your transition. Working these priorities through with your investment-only platform will be key to how your transition develops. They may evolve as your project evolves, but it's about, we've had clients where they were very keen to have upfront said, well, we must have a very short blackout period. But when we researched and presented them with the different options that were available for their transition and what the associated costs might be, there was some reconsideration about what that key objective was and how it might change. And that point about researching transition options is where an investment-only platform can really help. They can manage the transition project for you with dedicated resource that has the expertise to know how to meet your objectives and to balance your risks. They will usually have the relationship already with the fund managers and the scheme administrators you need or that you're working with. But if they don't, they have an established framework in order to get those legal agreements in place with those providers as quickly as possible. And so they can start testing those arrangements to allay any potential for risk. Another area here we have is that impact on members. And I've touched about the blackouts earlier and about what the requirement may be for your blackout periods, but also it's about the consideration of what you need to communicate to members and when, and building that into your timeline to ensure that your transition complies with what you've told your members you're going to do. Alongside this is the impact on the scheme administrator. If they have to make substantial changes to the member records and deal with ensuing member queries, what will that mean for them? Utilising an investment-only platform can help with this. If you use one of our white labelled structures, you can make changes of the underlying funds within the overall fund structure itself. As it were, we say making change under the bonnet, if you like. So you can swap the underlying funds, which will mean no blackout of trading. And if there's no significant impact on the overall investment objective, this means less member comms required. So that reduces the impact both on the scheme administrator and on your members. So if we take this slide down now, I think these are the kind of common points we see when we talk to our clients about managing change. So, but I think we do have another polling question here, don't we, Rachel, around what it means for because we'd love to hear from our attendees.
Indeed we do. So the question is, when transitioning assets, what is the most important thing to you and your clients? Is it minimizing cost, reducing out-of-market risk, minimizing the blackout period, minimizing impact on scheme administrator and members? So I'm going to share those results. So minimizing cost and reducing out-of-market risk, probably unsurprising. Those are each at 41%. No one said minimizing the blackout period, and 18% said minimizing impact on scheme administrator and members, and nobody chose the other category. So I think this is a really good place for Nick to join us.
Thank you, Rachel, and good morning, everyone. And the poll results there are absolutely fascinating. And I think looking at them, we can actually probably bring all three of those results back to cost. Ultimately, transaction costs will impact the effectiveness of a major transition. At the same time, there is obviously a cost involved with out-of-market risk. And as we've seen with volatile markets, that really is a true cost to the members. But at the same time, a complex transition can result in extra work for the scheme administrator. And again, there are obviously associated costs with that as well. But I think it's fair to say different trustees will place differing levels of importance on each of those key objectives. And to pick up on a point that Jess raised, the balance between timings versus costs is a classic example. Do we want to transition assets quickly and minimise the blackout periods, or do we want to minimise the cost? And whilst there's often a trade-off between the two, I think what our poll results there are saying is that the need to minimise costs for members, trustees, the administrator, very important. What I'd like to do now is perhaps look at the next slide, because these objectives and the type of transition will often determine which transition method is appropriate, and we'll now take a closer look at some of the methods available for clients when transitioning through an investment-only platform. So the first transition method that we'll look to consider is the re-registration of units. This is appropriate both for onboarding clients onto the platform, but also when they leave an investment platform. This can also be an appropriate method of transitioning assets. And essentially what we're doing here is if a client is invested in an underlying fund, so let's say they are invested in the platform they're leaving in a UK equity fund, they wish to move to the new platform but still retain that UK equity fund. It makes little sense to actually sell all one platform to sell all the units in that fund, only for the new platform to purchase those units. What we would do in that instance is incur transaction costs. There may be an element of out-of-market risk as well. So the re-registration of units between platforms helps avoid that out-of-market risk. It eliminates the transaction costs. The only consideration when using this method is that it can be a little bit more time consuming. Legal agreements need to be in place between all parties, that's the two platforms and the fund manager, and prior planning needs to go into when that re-registration of units is executed. But we find it's a highly effective method of re-registering units, and it's something Stella and I will be touching upon, no doubt, a little bit later in the session. The second method we'll look at, where perhaps re-registration of units is not appropriate, is the use of in-specie transfers. Now, in-specie transfers can be used for all types of transition. Again, that's money coming onto the platform, moving off a platform, but equally for our existing clients that are looking to perhaps restructure their existing assets that they hold with us. And essentially within specie transfers, I'll use another example where perhaps the client is moving from one UK equity manager. I'm picking on UK equity managers today, but where they're moving from one UK equity manager to another UK equity manager. And if you looked at what those two fund managers hold, you'd invariably find that probably 80–90% of the stock in their funds may be very similar. So rather than, once again, one manager sell all the stock to provide the redemption proceeds, only for the new funds manager to then buy that very same stock and incur all the costs that go with it, we can arrange for the two managers to effectively talk to each other and transfer stock between the managers rather than cash. Some great advantages of this, again, help to reduce the out-of-market risk. At no point is the underlying stock in the fund being sold during the process. It is held throughout the process, and you're also reducing transaction costs. And I know why I picked on UK equity for a reason, and that is because with things like stamp duty, when you're purchasing stocks, you're able to cut out a huge amount of cost for members. Now, again, there are certain considerations. It's not the quickest method of transition. It is more time consuming. Agreements need to be in place between the underlying funds managers. Invariably, there will be an impact on the blackout period. And fundamentally, between the two fund managers, you need to have that stock commonality. Quite clearly, UK equity funds and the stock that's held for that is not going to be compatible with fixed interest funds, for example. The third method that we'll look at are cash transitions. On the face of it, this is just selling one particular fund and then purchasing units in another fund. And on the face of it, there may be some risks that immediately become apparent, like out of market risk, but this can be mitigated through pre-investment. This is suitable, again, for assets coming onto the platform, assets moving off the platform, and again, transitioning assets for an existing client, be it bulk lifestyle switches, changes to blended funds. So cash transitions have multiple uses when transitioning assets. But by using pre-investment, we can help mitigate market risk. So essentially what would happen here is when restructuring a fund, perhaps the exiting fund is sold, and whilst we may not receive the cash proceeds from that sale for perhaps 3 or 4 days, at the same time as selling down units, we will buy units in the receiving fund to match the same valuation point. This helps to mitigate market risk. It is a simpler trade because it's simply a buy and sell of funds, so it's less project intensive. It helps minimize the blackout period. And with the Phoenix investment only platform, having the backing of a major partner like the Phoenix Group, there is capital available for pre-funding. And essentially what that means is whilst we haven't received the proceeds from the exiting fund manager, we are able to use our own capital to then purchase units in the new fund, matching the same valuation point to help our clients. In terms of, again, points for consideration for trustees, there may be some out of market exposure. Not all underlying funds have the same valuation point. So if, for example, we were selling from a fund that had a midday valuation point, but then buying units in a fund that had a closer business valuation point, we would have 4.5, 5 hours out of market exposure, and sometimes those circumstances are unavoidable. And as mentioned with the other two examples on this slide, transaction costs may well be incurred in the buying and selling of units. And the final method, this is often overlooked by clients, but it's one we try and encourage consultants and their clients to look at, is the use of cash flow rebalancing. This only really works for clients with existing assets on the platform, and it works for very gradual changes. So we had a client a couple of years ago looking to introduce emerging market equities into their default arrangement. It was only a small portion, perhaps 5–10% allocation to emerging markets. And we used cash flow rebalancing with the monthly contributions being fed solely into that emerging market equity fund. That helps smooth market volatility, but since we were having to invest monthly contributions anyway, we were effectively reducing transaction costs by conducting this change through gradual cash flows rather than in one larger transaction. But as stated, it isn't really suitable for large transactions. And if you're looking to build up a big holding in a blended fund and the cash flows are relatively small, it may take a significant time to implement those changes. So it's really a case of looking at what transition methods are appropriate, and it'll be very much dependent on client requirements. What we'd now like to do is actually run through some real life case studies and look at how these transition methods have been applied in practice. Shortly, I'm going to be joined by Stella Chaplin of the Atkins pension plan. But firstly, Jess has a case study for one of the largest DC asset transitions ever to take place in the UK. Jess.
Lovely, thank you, Nick. Okay, so if we move on to the next slide, this is a case study for you around a fairly recent transition that we in Phoenix worked on. This case study is really to demonstrate how utilising an investment-only platform can offer you assistance with managing change on a grand scale, particularly when there's a high degree of complexity and technical delivery. Okay, so as Nick's noted, so this was for a significant client that we had, and we'd won this client some sort of about 18 months previously on the understanding that we could deliver around this complete restructure of their DC offering. They were looking to introduce new managers and funds whilst removing some of their underperforming funds. It involved over 100,000 members, and in recognition of the substantial changes that were needed, the client's key objective was to ensure as far as possible that each group of members' investment journey had been identified. And once those journeys had been identified, it was to ensure that they were kept separately so that any cost associated would not impact any other members' journeys. You'd only pay for your changes and not suffer the cost for other people's changes. The key challenge for this project was making it happen within a given time frame, but still to reduce costs wherever possible. The client had been keen to make these changes across their membership for some time to align them all to the same lifestyling strategy, but had not previously had the functionality to be able to do it. And finally, the risk is clear in developing such fundamental change against substantial assets. So what do we do? So firstly, we worked very closely with the client to identify the key requirements and walk through the timeline for delivery. We engaged all parties to ensure the roles and responsibility were clear, and all 6 fund managers, whether they were outgoing or incoming, had signed up to an implementation plan with us, demonstrating they understood, they knew what they had to do and when. It was a year-long project delivered across 2 transitions that were about 6 months apart. Now, for the first transition, this was born out of the client's desire to diversify their assets within their blended fund structure. They want to do it as soon as possible. So for this first transition, we added 3 new managers, giving the clients our terms if they were preferable, or ring fencing their own if they had better terms with those managers. As there was no underlying stock commonality for an in-specie transfer, as Nick noted before, for that to be feasible, we had to do it all by cash transfer. But we enactioned this across 3 tranches to lessen the overall risk. Now, we made these changes within the client's white labeled blended fund. So we ensured minimal impact on the scheme administrator and members, with no changes to the member prices or units, no trading blackout, and no additional member comms required. So that was kind of our first, our test run, if you like. And then the second transition, which was 6 months later, was a much more complex one with the changes across the entire fund range. So to meet the client objective as regards the members' journeys, we created 27 individual member cohorts. And that was purely for the transition only. And it ring-fenced the costs for each of those cohorts journeys to that cohort. Now, this transition we had to deliver via both cash transfer and in-specie transitions. And wherever possible, we utilised weekly dealing funds at the managers to reduce the cost due to the larger pool of the underlying assets and clients. But also mindful with this transition was about the impact upon the members, because such a substantial transition is going to incur a corresponding blackout period. So in recognition of that, we allowed for the members for their monthly contributions to occur during the 6-week blackout period. And those contributions were delivered to the destination fund. So where those members' investments would end up at the end of the transition. At each stage, we worked with the client to ensure we understood what was needed, balancing the timing of delivery with reducing costs wherever possible. And as you can see here, we had a gross total of £5.9 billion worth of assets that moved with this transition in total. But what was the outcome for us? The key outcome for us is we ended up with a happy client. We delivered on time, without issue, as we'd worked through all those barriers to ensure that we got what they needed, reached their key objectives, and overcome the challenges as we went along to reach their goals. So this is an example of what we've done and kind of the barriers that may be to change and how we can utilize investment-only platforms to make those changes and get over some of those barriers. But again, I'd be really interested to hear from you guys now around from your perspective, what is the barriers you've had to potentially making change? And I think we've got another polling question, haven't we, Rachel?
Yes, we do. Okay, so when considering changes for your scheme, what are the biggest barriers to implementing change? Or I guess, what is the biggest barrier? We're hoping for everybody to select one. So once again, communication with members, time and cost of reconciling member records, the potential transaction costs involved in making significant changes, risk of errors, project management expertise and resource. And as you can see, 67% chose the potential transaction costs involved in making significant changes. I guess that's not surprising. Risk of errors, 20%, communication with members, 20%, and no one chose time and cost of reconciling member records or project management expertise and resource. Interesting. So I'm going to stop sharing that, and I believe Nick is going to join us now.
Thank you, Rachel. And fascinating there to see transaction costs is so prevalent in terms of the barriers that may prevent trustees from conducting a change. And that's understandable when we look at transaction costs. There's been a big focus on transaction costs in the industry over the last 2, 3, 4 years. And clearly it's a key consideration, which is why some of the methods we talked about earlier, the re-registration of assets, in-specie transfers, can help to mitigate some of those challenges. But essentially, whatever the challenges and barriers trustees face, it's the responsibility of Phoenix CIS investment-only platform for us to be a safe pair of hands to deliver a transition that meets those objectives whilst mitigating the burdens and the risks that are highlighted from our polling question there. This stage seems an appropriate time to introduce our guest, Stella Chaplin, Head of Pensions and Benefits from the Atkins Pension Plan. Welcome, Stella. And perhaps, can I start by asking you whether you can provide our audience with an overview of some of the transitions that we have worked on together?
Yeah, sure. Thanks, Nick. Thanks for inviting me to join this. Hopefully what I'll share will be quite useful. So we started working together in 2014 when we moved from our bundled solution over to an unbundled offering and transitioned the whole of our DC fund at that stage over. And then since then, we've been changing our investment structure, and you've been helping us with making setting up the mechanisms for the lifestyle switches. You've also helped us to restructure when we've added new investment managers onto the platform. And the latest thing is you've helped us focus on our current employees because we've moved our deferred members out to the master trust. So it's all about our focus on our current membership and making sure that they've got the right investment choices.
Okay, thank you, Stella. And perhaps if we think about one or two of those major projects, and clearly there's been a variety of work there that we've worked in conjunction with you on, but thinking back to perhaps some of the major projects and when they were first being considered by the trustees, what were some of the key challenges at that time that were facing you and the trustees?
So I think each one of the different transitions has brought a different set of challenges, but really, we're focusing on our good outcomes. And so we've got to make sure that we've got the confidence that we are going to be able to deliver that. So it's about making sure that we are focusing on the right deliverables. So if we take the first transaction, when we were moving from a bundled solution to an investment only platform, it was about the whole setup because this was completely new. So it's leaning on the expertise that your sort of team would bring to actually, how do you set that up in the right way and make sure all of the legal documentation, as you talked about earlier, is in play. That's a long time back, Nick, when we dealt with that one. I'm not sure I remember all of the details from back then.
No, it's a great example, and I do remember that during those projects, it was a leap of faith from the trustees, and I know the prime requirement at that time was really a safe pair of hands, and clearly there was a focus on the member experience as well. And just to sort of share with our audience, if we can just sort of bring the slide up for 30 seconds, if that's okay, which details that first transition. We were looking at moving roughly £400 million worth of assets across. And I think what we decided, Stella, is rather than trying to do anything too complex with the fund arrangement, we actually moved 12 of the 13 fund options via re-registration. So straight away, we've taken out the concern for your members around cost and out of market exposure. As we said, we had a blackout period of a month there. And essentially, one of the key features of this was the matching of units. Feel free to take the slide down, and I'll quickly describe what we did here, which was we worked very closely with the seeding provider to understand how they were conducting their unit pricing. And over a period of around about a month, we actually priced in conjunction with the seeding provider, so that when units came onto the platform, we wanted to avoid a scenario where all of a sudden a member who had, say, £10,000 in their pot, 5,000 units, they were worth £2 each, would suddenly day one say, well, hold on a minute, I've still got £10,000, but I've got 10,000 units, they're £1 each. My administrators had to do a huge reconciliation exercise. So what we did was we inherited not just the unit prices and the pricing mechanism from the previous provider, but we took back all that back history of fund prices, so that on day one, your members saw no change in the number of units held. The administrator had no costly reconciliation exercise where they're having to make sure the members have got the right amount of units. And the third benefit of that is around things like fund performance. So the trustees gained continuous fund performance. They were still seeing their existing funds and the historic performance, and members obviously got access to things like fund fact sheets as well. So I know that was a huge challenge. The whole setup was big, as you said there, Stella.
And you've lent into one of the important points for us. So, you know, that history of the investment prices and being able to track how things have performed. You know, I've got a group of engineers, a whole organisation full of engineers who are loving the detail. So if we can't provide that for them, we have questions galore. So, you know, it was quite interesting in terms of those polls. You know, actually a key one for us is, what is the member outcome going to be like, and what are the complaints that we're going to receive, and how we're going to manage those. So it's thinking ahead for that. So exactly that sort of example that you've just shared there in terms of the detail we could share.
And in terms of the challenges, obviously an active member engagement from your scheme, that's a positive thing, but that presents a challenge in itself. Are there other challenges that you see as you embark on these types of projects facing you and the trustees? So
for me, one of the biggest challenges is actually having confidence. So actually I've got to have faith that any project we're going to go into is going to deliver. So it's about bringing together the right people, the right expertise to actually support the project. You know, you mentioned earlier about member communication. We want to be able to go out and say, we are going to be going into blackout on this day, and we're coming out on this date, and your funds are going to move on this date. I'm not sure of all the intricacies of that. Phoenix, can you help us make sure that we're actually going to deliver that? And you come back and you say, right, actually, we can't do it here, we can do it there. You fit in with our timelines, and it's meeting those challenges to deliver the right solution.
Yeah, and I think that's it. It's a case of the parties identifying who those individuals are, and one of the things that we've always done successfully working with the Atkins pension plan is identify those individuals from outset. But are there any other sort of features of those initial conversations? I think back to some of the initial project meetings that we've held and the kickoff meetings when we've embarked on a transition. Are there any other sort of features of those or parts of the framework that you'd like to share with the audience that you feel has worked well on those projects?
Oh, so you know, if we're talking about how we manage our projects, we're obviously a project house, so we do like to have a project. But the big thing is collaboration. And going back to the right people doing the right thing. So if I look at the last transition that we've done, where we moved our deferred memberships out to the master trust, you know, we knew we were going to move a large, you know, moving a large amount of money for individuals. You know, each penny matters to every person, doesn't it? So you need to manage that effectively. We said to you, Phoenix, could you talk to the receiving scheme to make sure actually all of the documentation is in place, that we are lining up our assets, that the right decisions have actually been made, are we moving it in the right way? So all of that sort of challenge is coming through. We don't want out of market risk, you know, and we're moving money sometimes when it's fairly volatile, and it's talking about that with the people like yourselves. what are the risks involved? What are we taking into consideration? We want to make sure we don't pick the wrong time of making those sort of transactions. So it's all about planning. It's also all about bringing together the right people and, asking the experts. You remember, Nick, all of the things that you've done to support us through these transactions.
Yeah, and I think one of the things we've always done is have those meetings and those discussions well in advance. So we've always had typically a good 6-month lead-in. Now, that doesn't mean that transition projects take 6 months, but if we want to facilitate the re-registration, the in-specie transfers to reduce costs for members, which we saw was so important for our audience, a good 3-month lead-in to get that planning, to get that documentation, to agree the approach is essential. I think you've always provided that to us. Incredibly, though, I think the change we made with your default was in a very, very quick switch, and we were able to undertake that in one day. And that was where we changed one of the assets within your diversified fund. And essentially, with the valuation points matching, we simply sold one fund, brought in another fund on the same day, and there was no blackout for members whatsoever. So even though that was a substantial change and a substantial size of assets, members were still able to switch in, switch out. And I suppose from your point of view, where those changes are straightforward, the implication on the communications, I guess, becomes easier, does it, Stella?
The implication does become easier, but that doesn't mean you haven't got to plan. And going back to a point that you made before, actually the way our relationship works is that we are regularly sharing information about what's the direction of travel, what are the trustees looking at, where do we think we're going next. So hopefully you don't get blindsided, and actually, so therefore you're ready to support the investment structures that we have in place and what we do. I don't think we communicated a great deal about the change to that investment structure you're just talking about there. As you said, because we've got white labeled funds, actually it means that we can improve the investments where we need to, where we've got to make a switch out, and do it in a painless way for our members. So they're just seeing the good outcomes and that the trustees are doing the job that they're expected to do.
And coming back to obviously a previous point, not seeing changes they're not losing their performance history, they're not seeing a change of units, that they log on to their website one day and they see exactly the same number of units the day after the change, and that it looks completely seamless from administrator and member perspective. We probably touched upon some of this, but looking at or picking on one of the projects as a whole, what outcomes did we achieve for the trustees working together and your members, and what has a successful transition looked like for you?
So yeah, different ones in terms of all of the different projects that we've been through. Back to moving from the bundled to the unbundled. The bundled solution wasn't delivering what we wanted to deliver for our membership. So, actually trying to do things in a different way, making sure we're engaging with the right people. We want to deliver good outcomes, and it's about picking the right investments, being able to move them at the right time. So a strange measure, I think, for us as an organisation, one of our measures is no complaints. So actually we have to have smooth transitions. We have to have all of the data in place. We have to have, successful management of transition costs, because otherwise those are the things that are going to come back in the member complaints, because they do get into the detail. So it's about the right team pulling together. So having teams that you can lean on and have confidence in, and we've built that up with working with Phoenix over the last 5 years.
And I think it's so important for an investment-only platform, because we don't hold member records. We don't have the telephone lines from individual members. So it's very easy for an investment-only platform to become perhaps detached from some of the realities for members. But essentially, that's why it's so important to have that close working relationship. So we understand the implications for you, the implications for your scheme administrator, and that when we do something, even though it just looks like a trade between funds managers, it's understanding that there's a knock-on impact down the line somewhere in terms of it could be transaction costs, it could be fund reporting, it could be complaints that you're receiving, Stella. So I think coming back to what you said there, knowing what you're trying to do at an early stage, and then working with you through some of the options as to how we can plan it, how we can take some of those risks off the table is a formula that works well.
And Nick, going back to that, you know, I've recalled in the past that you've helped us where we've actually had a member complaint around what's the transaction costs, and you're able to go back to the records and go, well, this is what's happened, and actually we've netted off transaction costs here against this because of different transactions moving in and out. And we're, you know, being able to go back to the member and say, look, this is what we've done. Actually, we can be quite transparent with people about what we're doing because we've got that confidence.
Yeah, and that featured in part one of our webinars, where we looked at how platforms net off. And sometimes you as a client, Stella, you might be sending us through an instruction to sell units for a member. But if another client is actually buying units, our net trade to that manager is buying the units. And in that instance, it would probably favour your individual member. So it can sometimes work like that. But that's complexities possibly for another day.
Yep.
Final question for you. What would you consider to be the main benefits that an investment-only platform offers when implementing changes, or indeed more generally?
So the big plus for us about an investment-only platform is that we get to choose the investments that we think are right for our employees and the members of our plan. And actually, you know, working together with the administration and yourselves, we actually can pull that together in the time frame that it fits our schedule. And, you know, it's more bespoke and it's personal, and it's about, you know, delivering the right result for our pension scheme.
Absolutely. Well, thank you, Stella. I think today your insights and the experience you've been able to share with our audience has been invaluable, and I hope the audience has been able to take away a number of sort of the best practices that we've seen in working from yourselves. So thank you. Over to you, Jess.
Lovely, thank you, Nick. And thank you so much, Stella. And hopefully everyone's found that really useful in terms of giving some live examples of the kind of things that an investment-only platform such as Phoenix can do. I think we've just now got the summary slide before questions. And really here, and I think what came out very clearly from Stella is that, yeah, partnership is key to delivering transitions from investment-only platforms. And as I think Stella's used the words, I think it was bespoke and personal, and I think that is never more important than we're making change for you and your members. Each transition is always different. It'll be bespoke to what you need when you need it, but an investment only platform should work with you and build that time with you, as we talked about before, to understand what matters to you and your members and how to deliver it. So whether you're coming onto a platform or leaving it or making a restructure, a platform should support you in meeting your objectives, overcoming your challenges and mitigating the risks. Where possible, it should work with you to make less impactful or gradual changes. So I think Nick discussed earlier about how to make gradual changes with cash flow allocation. And then also we've talked about making less impactful changes. So when onboarding, about inheriting prices to ensure smooth continuation of performance and fact sheets. And I think the other point here is around, where possible, about easing that burden on the scheme administrator, ensuring that members are not significantly impacted and that they don't see that interruption of fact sheets. As Stella said herself, no complaints. If we get to a point where the members are happy, then the scheme will be happy too. And I think finally, when significant change has to happen, as it does, an investment-only platform can do that heavy lifting for you. From the concept through to delivery, from legal negotiations with fund managers, to reviewing the different options available to you for your transition, to utilising its capital to help to support pre-funding requirements. And then finally, it's that piece around the costs. What is it going to cost you, where you can demonstrate to your members where you've saved costs, but then also just getting that report about how much it's cost you. An investment only platform can pull all that together. It can use its expertise and its scale to give you the information that you need to support you and your members. And whilst an investment only platform may not be a transition manager itself, it might not buy or sell your underlying assets, it should manage that transition for you to deliver those outcomes that you need. Okay, if we take the slide down, I think that's it. And we do have some time for some questions. So if anyone has any questions for Nick, myself or Stella, we'd love to hear from you. Rachel.
Fantastic. So we've got one that came a bit earlier. How many transitions do you typically manage in a year? The person says, my current platform couldn't fit my restructure in when we needed it.
Ah, okay. Yeah, well, and I'll probably, I will probably to Nick as well. From my perspective, it really depends on the transitions you're delivering. I mean, I should make the point, as we've said with each of the transitions we've discussed today, even that first case study, it may have taken up to a year to deliver, but that doesn't mean other work wasn't carrying on. There is a dedicated transitions team within Phoenix, and so that we had allocated resource to the different transitions. In terms of how many in a given year, what would you say, Nick? I mean, I'm just trying to think. We can manage as many as required, but clearly where there are transitions that take, when they're actually happening, we try and concentrate on those themselves. Wouldn't you say, Nick?
Yeah, absolutely. I think it very much depends on the complexity, the transition. The case study Jess ran through was probably the lowest we conducted within a year, given that there were several key milestones within that project. But I think realistically, we've seen other years where we've had a lot of cash transitions, typically smaller transactions. We're looking to match valuation points in those instances. And realistically, you could do one of those every 3 days. So the capacity there is incredibly large, but where you get into the complexities of needing legal agreements for the re-registration of assets, we wouldn't want to be re-registering £400 million for Stella and her scheme, and a day later be re-registering a similar amount for another client. That quite simply would be covered with risk. So we'd leave a good sort of interval of probably 5-10 days between the projects to ensure that the assets are very clearly earmarked for each client, and we're taking risk completely off the table. So much depends on the complexity with that one, but it's a great question.
Yeah, and I should just note that obviously with that we would work with all parties, so it's not, we would know, so any kind of client would know well in advance about the timings of that. It wouldn't be like a last minute decision, so we would build that into the timeline from very early on. And
I should add as well, Jess, we've not had to delay a client transition by months. We might have to move it back 2 weeks, say, with the 2 case studies we've just seen, but that's really the maximum I've ever seen in the last 4 or 5 years.
No, not at all.
Very good. Another question that's come in before the webinar, actually. What is the most common change your clients are considering?
Well, yeah, I'd say currently it's adding in ESG. So unsurprisingly, it's adding in ESG solutions. So currently we have, all our clients are looking at a range of different fund managers. So as I said earlier, it may be utilizing fund managers they haven't used previously. So we're setting up both the funds and the managers on behalf of the clients, and then adding those in. Some of them it's for standalone arrangements, for their standalone funds, but for most clients it's how they can incorporate ESG funds and solutions into their default, and that work is ongoing, and even within COVID, clients are still looking at that change.
Right. And then I'm going to ask each of you to give about a minute to the next question. So what does a successful transition project look like to you? Why don't I start with Jess, then Stella, then Nick, or maybe you have a different order?
Well, let's start with Stella, actually. I think I'd like to hear from Stella first.
I think I answered this partially before, actually, when Nick and I were talking. So success is that actually that what we'd planned out to achieve has been done in the timeline that we said we were going to do it in, and actually meeting all the objectives. And a sweetener on the top is making sure that we keep the transaction charges down. So actually being able to look back at a movement of our investments and say, yeah, actually we've achieved and done it in the best way possible. That's success.
Thank you, Stella. I mean, for me, it's about, it is that point about a happy client. It comes down to ensuring that wherever possible, we have mitigated cost. we have we have taken the risk as far off the table as we can, and delivered. And to me, that's doing it on time in the way that the client needs it to be done.
And for me, I always think about the member at the end of this. This is who we're providing benefits for. And if we're able to undertake a transition that minimises the impact on members from a risk and cost perspective, and I think as Stella alluded to earlier, we deliver the transition in the way that we say we do, both in terms of timescales and method, that to me is looking like success.
Very good. Thanks to all of you. Nick, how do you manage market volatility during a transition?
Yeah, the management of market volatility is an interesting one. Clearly, COVID has brought about some incredible market movements. We've seen market movements this week of 2.5%, 3%, and clearly at the height of the crisis, it was more than double that. It's always a risk that we look at when managing transitions. We hold no-go calls even, during the transition project, where all parties and all stakeholders assess the risks and the conditions that need to be in place for a project to take place. Stella and I have had calls before where we've looked at market volatility, not on the level that we've seen more recently. And ultimately, I think, Rachel, if we see market volatility at high levels with a cash transition that would see out a market risk, then there is the option to pull the transition. We've not had the option to do it, but we've got a control in place that would see that occur in the event of extreme volatility. However, it remains to be said that if we are using in specie and re-registration as a method, the concern around market volatility largely goes away. So again, depends on the method of transition and again, market conditions at the time. We can't second guess the markets, but we can at least have a control in place that allows all stakeholders to have a say on that.
Oh, very good, Nick. Thank you for that. I think this is going to be our last question. I think it's for Jess. How many funds do you hold on your investment-only platform? And what are the most complex fund types you hold today? For example, do you hold private equity funds?
No, oh, lovely. Thank you. I did see that question come through. So from our perspective, it's more about the relationship with the fund manager, actually. So as long as you have the agreements in place with the fund manager, adding individual underlying funds is relatively straightforward. It can be done. Usually we do it on client or consultant requests, but a lot of the times, if we think there are interesting new funds that fund managers are now promoting, and for example, an example would be, say, private equity funds, we will therefore add those to the platform. In terms of numbers, so as I was saying, in terms of numbers, it's largely about how many, because you can have as many. Our platform is truly scalable, so you can have as many funds and also different fund series of those funds, depending on if a client has a particular agreed fee for that fund. So you can have as many as you like. What's really key is ensuring that you have those agreements with those fund manager groups. And we, I believe, have about 70 plus of those agreements. So adding funds can be done in weeks as opposed to months. And the other point around about those more complex, as I said, we're seeing private equity funds adding to the platform. We already have target dated funds, we have exchange traded funds, and increasingly ESG funds. So yeah, it really is up to the clients and the consultants about what they need, and platforms such as Phoenix, it should be able to add those for them.
Right, well, fantastic. That's all we have time for today, I'm afraid. Many thanks to all of you who joined us today, and a big thank you to Jess, Nick, and Stella, and their Phoenix colleagues, and my PLSA colleagues who helped put this together. We hope to see you all soon, and thank you for joining us today.